It's great to see your handsome face in living color again, Vincent. It's been way too long.
I know. I want to drop by, maybe go visit Wynn, Vancouver. But no, do you still have anything in Bellevue, or are
Not in
you?
Bellevue. We now live in the summer in Liberty Lake, Washington, which is right on the Idaho border. And
You know me.
we
That's
have our
you know
boat.
that, that's the last corner of the U.S. that I have not visited.
Well, then you have the perfect reason to do so. You've got an open invite. We have the boat that
Do
you,
you fish?
it's an
Do you
updated
fly,
version of the boat
do
that
you
you
fly
bought.
fish?
I don't. The fish are very safe when I'm on the lake. No, I used to fish when I was young, but that was salmon fishing in Alaska with my dad. But so anyway, I wish I could pronounce your name as melodiously as Louis Gaube does, but after all, he is French, so he's got a bit of an advantage. How does he say it? How do you say it?
Deluard, but you can go whatever you like.
And how about is it what I call say Vincent? He's got a beautiful way of saying that. What is it like Vincent or
Vincent Deluard.
there you go. Yeah, that's I don't know how you guys pull that off. But anytime anybody speaks French, it always sounds so appealing. So, but I got to say, Vincent, it's getting hard for me to pick up a Barron's edition, which I read every week without seeing your name in it. And you've become a regular, so congrats on that. You're not just a rising star; you're more like a shooting star. So, and before we get into my interrogation, sorry, Q&A, let's start with a little background on thou. And I follow you going all the way back to Ned Davis research days, but yeah, just feel free to give us some background on
Okay.
your career.
So yeah, so I'm the director for global macro strategy at StoneX, which is a global financial service firm. As the term global macro implies, it really means I get to write about anything that I find interesting, which is a wonderful thing because markets are there's always something happening. There's always something new.
Like today, a lot of progress today, and it's not July.
For me, it really is the most interesting job in the world. So I write 4 weekly reports, 4 monthly reports that get sent to institutional clients all over the world. Historically, my client base has been in mostly Europe, where I'm from. I was born and raised in France, as is evident by these beautiful French soccer jersey with 2 stars.
Yes, congratulations.
Thank you.
For the World Cup, right, with Argentina?
Yeah, it's going to be a beautiful final. I mean, it's, I'm sad for Morocco, but it's, it is a logical final. It's 2 great teams. So whoever wins will be worthy of it. So anyway, so Europe, lately I've been working a lot with Latin America, Brazil especially. We sell, we're a broker dealer. So we cover equities, options, commodities, fixed income. So the best way to follow me is for retail people, I would say Twitter. I found some fantastic people on Twitter who've helped me a lot over the years, and I try to, put snippets here and there and try not to get into too much trouble. And then for institutional clients, if you're already a client of StoneX, just reach out to your rep to see if you can get added to my list. Or if you go under my Twitter profile, my Twitter handle at Vincent Deluard, my pinned tweet has a link to register for a free trial. We grant 100% of these, so you can get free research for a month. And always feel free to reach out by DM. I try. I cannot always answer everything, but I hopefully the holidays are coming, so I'll have time to catch up on my mail.
Excellent. Thank you for that overview. And you do write, I say this with all sincerity, you do write brilliantly. You are absolutely one of my favorite sources. In fact, I don't know if you've read, maybe you've read parts of my book, Bubble 3.0, but I quote you extensively and give you well-deserved kudos in that. So one of your most provocative recent pieces was titled Silicon Valley's 7 Deadly Sins. Would you mind recounting that? And which of those sins, by the way, do you think has been the deadliest?
Oh, hard.
That's a tough one, isn't it?
It's hard to pick a favorite. I would say maybe the worst one I think is a stock-based compensation, just in terms of size, how much stocks have been issued by Silicon Valley. I think once the story of Bubble 3.0, as you call it, will be written, all that will be left will be a fantastic transfer of wealth from investors to Silicon Valley insiders and tech employees. And it may be my jealousy speaking, because as you know, I live in the Bay Area, and I see a lot of my friends who started working at about the same time as me and enjoy very nice, comfortable lifestyle with, naps at the office and yoga rooms and retreats in Hawaii. And then every year, on top of their very generous salaries, they get about twice that in stocks, and they've been getting that for 10 years. I mean, I know a lot of people who even retired like in their late 30s. I mean, it's fantastic. Like if you, and not people who started companies or sold companies, just who went through the rank, like got a job at Google. I mean, they were very smart. Like people who got a job at Google 15 years ago, I'm not questioning that. I think lately it's changed a bit, like 2020, 2021, they just went crazy on the hiring binge. But people who got a job at Google 15 years ago and stay for 15 years are usually pretty smart. But it's very unusual to see people in their mid to late 30s able to retire just by holding a job. And that's what the stock-based compensation scheme has afforded. So I'd say good for them. But of course, as a society, I mean, this is not a sustainable way to run an economy. And I think we are dealing with some of the consequences of really 10 years of excess in tech. We are seeing the layoffs now. But again, it's so the bubble was so massive that we were really just barely scratching the surface here. Do you want me to go?
That's an important point. I definitely want to come back to that, because
do you want me to go through the list of the 7 sins?
Yeah, the recap would be great.
All right. So the first one was printing stocks to pay employees. So you look at big tech, it's about 30 to 40% of expenses are stock-based compensation, which is big, but it's pretty stable. If you look at outside of the big tech you FANG, it's more like 60 to 70%. And then really, it's really just a money printing machine, right? I mean, instead of, you don't have to raise cash, you pay stocks, and it's a transfer of wealth from shareholders to employees. And it's getting worse now because, of course, the stock prices are down. So they need to give a lot more stocks to get to the same dollar amount. So the amount of dilution that people are taking on top of having lost like 70 to 80% on the stock price, and then the stock count like doubles every year. I mean, this is really shareholder abuse.
And that stock compensation, that stock compensation often doesn't impact the P&L, right? It's often considered to be a non-operating expense.
Correct. So well, it doesn't impact cash, right? This is why they always stress on a free cash flow basis, because it's a non-cash expense. And then the typical adjusted EBITDA measure then adds back to it, considers it's not an expense. Well, and we had this debate. I mean, I'm sure you remember back after the first internet bubble, how do we account for stock options? And Warren Buffett was very vocal about it. And if you regularly pay more than 50% of your wage in stock, it is a wage expense. It should be expensed. I mean, I think it's very settled here. And to some extent, I blame investors for not caring enough. I think there was this benign neglect when everything was going up, right? Everybody's making money. So shareholders understood they were getting ripped off, but it's okay. We're all getting rich here. Stock price going up, so I don't mind. I think now that we are seeing the market correct, this behavior, this practice will have to be reined in. And it will show really that a lot of these business models don't work. Like they do not have the cash to pay their employees because the underlying economics are just not that good. So it's kind of exposing almost the Ponzi aspect of a lot of these fake tech company. Speaking of fake, my second sin was buying fake growth. So that was really the mantra of the past decade, right? Is you need to show the growth, right? You need to show the growth. Don't worry about the profits. Eventually, you'll become profitable, kind of like Amazon. So you spend a lot of marketing, you heavily discount your product, and then you show this, hockey looking. And really, the goal of that growth is just to convince the next VC to do a series. I remember when I came to Silicon Valley 15 years ago, there was Series A, maybe B. I mean, now you see companies that are doing like Series F, series, J, H. I mean, just keeps going, right? I mean, they never
I have
get.
to get into double letters soon.
Yes, but you need the key to get there is to have that growth, right? Because then you get a higher multiple, and then you get to raise at a higher valuation. So that's why you want to buy that fake growth, and the way you do that is a lot by actually spending a lot of that money back into the ecosystem. You buy ads, AdWords on Google, you buy advertisement on Instagram, on the Meta platforms, on Facebook. So it's almost like a circular economy where the bubble company, a lot of the revenue of let's call them legitimate big tech companies that do have legitimate business models, they're not completely insulated from the ridiculousness, because they get some of that VC money being flowed back into them via the advertising channel. Sin number 3, inventing new accounting rules. We've seen a lot of that. The most infamous was WeWork, the community adjusted EBITDA. I mean, WeWork really had a way with words. I mean, it's, it may not have been a great company, but in terms of creative writing, they deserve a very honorable mention. Sin number 4, spending $2 to earn 1. See a lot of companies, you're like, wow, you have like revenue of like 100 million and expenses of like 300 million. I mean, wow, how do you even manage to do that? Number 5, overhiring workers. Now, this is being addressed now, but this was insane, like 2021. I mean, I have friends who are at Google or Amazon, Microsoft. They tell me they couldn't even do their jobs. Like, all their days were spent interviewing candidates, and they had these insane targets of doubling the team size every 6 months, because they were all going to have 100% of the cloud business, 100% of the enterprise this. And it was insane. There was this. It kind of reminds me of what happened with banks in 05, 06 during the bubble, when the banks would go on that's when I was in grad school. They'd go to American campuses, and they'd wine and dine. They hire the class of 2006 was twice the class of 2005. They kind of mistook what was a once in a generation event. In the case of tech, that was COVID, and then the shift to digital that created a lot of demand, and they thought that was going to be permanent, and they hired accordingly. And of course, they have to backtrack on that, because a lot of these people there's just no job for them. I mean, this is the dirty secret of Silicon Valley, and you see that with Twitter, right? I mean, you can fire half the company, no one even notices, especially the product manager type. I mean, I would love someone to explain to me what a product manager does and why Meta needs so many thousands of them. Sin number 6, the buybacks, wealth destroying buybacks. So this is linked to sin number 1, the stock-based compensation scheme. Because you issue so many stock options yourself, now for the legitimate companies, they're trying to cover their tracks a bit. They don't want the share count to go up too much. So then they'll do a buyback after that. So Google is notorious for that. For example, Google has a big buyback program, but the share count is always the same. So really, the buyback is just offsetting what they give themselves. The worst buyback that I mentioned is Meta, where it's just horrible, because not only they give themselves a lot of options, but also they bought way higher. So I calculated they destroyed something like 75 billion in shareholder wealth with this buyback. Half of that was from the stock-based compensation scheme, and then the other half was from just buying too high. So again, I think this is a practice that is going to be problematic in 2023. And then the last sin, more of a Tesla issue, but some of it is to create a cult following among retail investors and analysts, and basically try to almost manipulate the crowd into being irrational, which works great for the stock price, but means that the market is not efficient, and the value of the company is not real.
Good. That's a nice summary, and it's a good lead into what my next question, which is, a multitude of investors seem to believe today that the tech bear market is over. But might this be more like the 2000 to 2002 experience, the tech wreck back then, that took the NASDAQ down almost 80%? And yet there were some really stunning rallies along the way. So do you think it is akin to that?
I mean, I think we'll see more rallies like the one we just had, like the one we had this summer. And that's a risk, by the way, for people like you and me who've gone through the the first tech bubble is we know how the movie ends, right? So we want to get there, but along the way, you get these nasty bear market rallies that can just like rip in your face. And I must say, I've underestimated too. Like I'm shocked that the amount of faith and the hope that investors have. They have not given up on that story at all. I mean, if you look at the flows into actively managed growth ETFs, these ETFs are down 70-80% from the top, and yet you see month after month money flowing in. I mean, my first job out of school was to track fund flows for a small firm in California. And there was one iron rule of fund flows: is flows follow performance. If something's up, people will buy. If something's down, people will sell it. I have never seen such a huge divergence between performance and flows. And to me, that means that narrative that people are clinging to it, the view that, and it's in some way tied to the macro picture. It's the view, inflation was an accident. It was never real. It will go away. We'll even have deflation next year. And then when we do that, the Fed is going to cut. The Fed is going to send us QE again, and everything will raise back to the moon. So we'll just have to be stoic, take the pain, and then we'll be rewarded in the future life. I think this is still the mentality of most growth investors. And this is why the flows are much more resilient than I expected them to be. And in my mind, this is why the bear market is not over. I mean, bear markets bottom.
Yes, you had mentioned that last month about these rather inexplicable inflows, and yet with bad performance, and I've never seen that happen before either. But you are, as far as I know, the advocate of one of the more intriguing rally indicators that are out there. In fact, I used it at the end of June or mid-June, which is this rebalancing idea of these target date funds. These are 401k plans that or assets that are largely 401k driven, and they become so huge that when you have a bad quarter like you had in the second quarter, and where bonds held up, bonds were down, but they weren't down nearly as much as stocks. So you get this rebalancing effect. So that thesis of yours gave me the courage to call for a rally, when things looked really bleak in mid-June, and it worked. In fact, it worked better than I thought. I kind of chickened out after a 7 or 8% pop, and it went on to about double that. So that's a really interesting way to look at things, but that wasn't behind the recent rally. The recent rally was, I think, more about, peak inflation, peak Fed tightening type of thing. So anyway, this, you were talking about buybacks, and one of the things that's kind of sobering to think about with buybacks and tech is that this tech wreck this time has happened with buybacks still running very strong. What happens when that buyback music stops, which it always does at some point?
Yeah, I think that's one of the reasons for caution next year. I mean, we had, peak to trough, 24% down on the S&P, a bit more on the NASDAQ. We had close to $1 trillion in buyback last year. And the reaction in the first 2 quarters from the very rapid stock declines from corporate treasury was to buy a dip, because the economy was still strong. I mean, in general, that's been my view, that the economy is stronger than the consensus thinks, and at least I think that's what CFOs were seeing. Like, people talk about recession, but look, my revenue's up, funding conditions were still good, rates were low. Companies had a lot of cash from COVID and a lot of the issuance that took place in 2021. So it seemed to make sense for them. Hey, stock price down 15%, and let me buy some. So that's how we got these kind of record level of buybacks in the first 2 quarters. Now that is starting to flip over. I think we're running at about 250 billion a quarter, and now that's closer to 200 billion. And I think that keeps slowing. Also, because there's going to be a piece of legislation in the Inflation Reduction. I love that, the Inflation Reduction Act. There's a tax on buybacks there, which, I'm not going to make people have strong feelings either way. I'm not sure how that reduces inflation, but I'm not sure how anything in the Inflation Reduction Act reduces inflation. But anyway, there's a 1% tax on buybacks on the margin that will discourage repurchases. And then just the environment is not the same, right? I mean, junk issuers, you pay 9% on junk debt, or a bit less with a rally, but still, you pay close to 10% of the debt, and most stocks trade at more than 17 times earnings. So why pay 10% to buy something that yields on an earnings basis about 5%? The incentive is just not there anymore. And I think also a lot of treasurers are just going to be generally more careful, right? You have risk of recession, which I think are overblown, but generally lower liquidity, right? I think that is the big story for 2023 is, we came from a world of abundant liquidity, and then the liquidity is being sucked out the system. So what you want to do is preserve what you have.
Yeah, I want to get to that because that's one of your more intriguing viewpoints and very non-consensus. But I'm just wondering if maybe the WeWork's PR department helped the Biden administration write the title for the Inflation Reduction Act. That sounds like some of their syntax talents. So one of the things that you were really prescient about was writing about the demise of the typical 60-40, 50-50 balance type of portfolios. And that was a great call up until about October 13th. And then it's had a big renaissance. And I guess my question to you is, do you think, I think you believe this, that it's been a counter trend rally? In other words, a bounce back, kind of like a bear market rally, and that the decline will resume and that people will start losing money on stocks and bonds again? But I don't want to put words in your mouth. Do you disagree with that, or do you think that's fairly accurate?
Yeah, that is absolutely accurate. I'm sure we'll get to the inflation conversation later, but the reason for my belief that the 60-40 portfolio is entering what I call the nuclear winter is the rise of secular inflation. Fundamentally, the 60-40 portfolio is a product of the great disinflation of the past 40 years and the fact that rates were falling. And as a result, stocks and bonds went the opposite way, and you could beautifully hedge an equity position with a bond portfolio. You got paid to hedge, right? I mean, you even had positive real yield with something that had a 90% negative correlation with stocks. And we had for about 20 years, with the exception of 2008, your 60-40 portfolio gave you a steady 8-9%. I mean, this was the bread and butter for our industry, right? I mean, you didn't need to be a genius to make money. I mean, you could just, put them in the 60-40, do a couple of client calls and then go play golf at 3 p.m. I mean, this is why our industry, clings so much to this era because we made so much money working so little for it. And I think this is why there's so much resistance to the notion that it's going to be different going forward and that secular inflation is going to change that. Now, yes, you're right. We have a good rally in the 60-40. I would say we've had the same thing in the summer as well when we had the first negative inflation, well, slightly harder than expected inflation print. It was actually bigger this summer. And in the exact same way, it appears to have stopped the 200-day moving average. So my view, yes, it's still a bear market rally. And going back to the 60-40 portfolio, yes, we had a big rally in the long bond, no question. But break that down one day is when the market is up and the market is down, and you'll see that all the gains on the long bond happened when the market was up. Now, typically, that's not what you want, right? You want your long bond to work when stocks go down. So to me, it's not so much a change in a regime. We are seeing the same regime. Stocks and bonds move together. It's more change in sentiment. We move from extreme fear when the market was dropping like a stone to optimism about peak inflation, peak Fed, and that just lifted everybody. But that doesn't change the fact that your 60-40 portfolio is fundamentally broken.
Yeah, it's still been a very tough year, one of the worst years ever. At one point, it was the worst in a century for a balanced portfolio. That's eased off, but like you, I suspect that there's going to be another downside test. But one of several reasons that I'm excited to talk to you today is that, unlike most macro strategists, I kind of alluded to this earlier, you think the U.S. economy is stronger than popularly believed. I mean, it seems like almost everybody I respect believes the 2000 recession is a done deal, if not already here. And frankly, I joined the recession camp kind of reluctantly last June. But I think you disagree, and I want to hear what you have to say, but then I have a suggestion on why maybe both could be right. But please take it from here.
Right. And then I would make the same comment, like my smartest friends are in the recession camp. and it's hard for me to argue against people like Mike Green or Alex Gurevich, who are so much more accomplished than I am. But I would still say, like, if you just look at the fact, I was right. I mean, GDP is growing. We are not in recession. We actually had accelerating growth in the past quarter. You look at the survey, like all the big economic release consistently, whether it's the non-farm payroll, the average hourly earning, the retail sales. I counted out of the past 12 months, the consensus has been too bearish for 11. So to me, it seems that there is something that's going on that the market is not seeing. Now, I'm going to play devil's advocate. The counterpoint that I hear from my friend is that it's going to take time. It's just taking time, but it will happen eventually. Like, the Fed has hiked, 400 basis points in 6 months. So it's going to fall. We're just not seeing it yet. Maybe. My view is that there's something else that's going on in the economy that the market is not seeing. And what the market is not seeing is the rise of the gig economy. That the
Just
economy,
to be clear, you're saying the gig,
the gig
GIG.
economy, correct. The GIG.
Sometimes called the side hustle economy too. Is
that too? Yeah, basically people driving Ubers, taking second jobs, having the YouTube channels. If they're pretty, having an OnlyFans channel, big Instagram influencers, driving trucks on DoorDash, or even just taking a straight out a second job in secret. I know a lot of people in tech would do that. Since we all work from home and, there's not that much to do. If you're a product manager at Meta, you can very well you can be a product manager at 5 different companies and accumulate. And by the way, you see that in the data. If you look at the gap between the establishment survey and the household survey in the job numbers, that gap has become positive. And that gap is indicator of people taking multiple job holders. That's the difference between the two surveys. And I think the way I see it in the data is looking at tax collection, which I follow with a lot of attention. And if you look at a category called individual income taxes, which is not derived from your primary employment, that is just on fire. I mean, this is up by 50% this year, which is up 50% last year, and it's about 20% of the size of the economy now. And to me, this is the fundamental transformation of the US economy of the past 20 years. Is you call that a great unraveling. Like when I learned development economics, you had your informal sector, like you go to a country like Peru or India, and everybody pays in cash, and and as an economy develops itself, people get real job at factories and with benefits and so forth. That's the normal development path. It seems to me that the US is walking backwards, where we are shrinking the formal economy. It's been shrinking for 15 years, and also because the new generation doesn't want that, right? I mean, the Gen Z or the millennials, they don't want to, work all their life at Goldman Sachs or IBM. So it's not just coming from companies. I mean, companies love it because they like the flexibility, right? It's much better to have an Uber driver than a cab driver where you have to pay benefits. So it's kind of this meeting, and then you have the technology that facilitates it. I mean, all the innovation, not all, but a lot of the innovation of Silicon Valley for the past 15 years has just been about, I like to joke, it's called reinventing the coolie. In India, where you have a guy that drives your kid to school, that fetches you a sandwich, clears your laundry. That's basically what we've done, with Uber, with DoorDash, with OnlyFans. We just recreated this kind of tiny, flexible arrangement. And to me, it's not entirely bad. Like, I mean, if people can get paid doing it, then it's flexible, but that means that the economy is a lot more resilient than the market think. And that also means that the labor market is a lot tighter than the Fed thinks. And I think that's the mistake they made in 2021, is they thought that, basically the problem in the US is about anywhere between 3 and 7 million missing workers since COVID, right? It hasn't really recovered. I mean, Powell even mentioned that yesterday. And in 2021, the Fed thought, oh, these guys are going to come back. They're just sitting at home, watching some Netflix, getting some stimulus checks. But when the checks dry up, they'll go back to the labor force. And they've never come back. And my impression is that a lot of these people are working gigs. They are earning, but it's not really showing up in the data. And that means, one, your labor market is tighter than the Fed thinks. And two, your consumption is more resilient and will remain more resilient next year as well.
So it's almost like a shadow economy, kind of like the equivalent of the shadow banking system.
Correct.
And in listening to you, what it triggered, because I was just listening to this on the Talking Heads on CNBC, talking about how the Fed is really worried about the participation rate being so low and kind of chronically low, which is another way of saying what you just said. It used to be something like 67%, I think, at the peak, somewhere around 2000. I think it's down around 62%. But I think what you're saying is, in reality, it's actually a lot higher.
Yeah.
If you have people working 2 jobs, for example, I mean, that's really, your participation rate is undercounting those folks.
Correct. And there is a dark side to it. So I focus on the bright. I focus on the bright side, and I think both are true at the same time, right? It's the tale of two cities, right? It was the epoch of light, it was the epoch of darkness. I mean, it always like that. So there is the beautiful story, which I mentioned already, which is the gigs, people, being more flexible, etc. And then there's the darker side, which is mental health, obesity, depression, anxiety, and then an unusual rise in sickness too. There's a lot of very worrying data on the health of the US population. I mean, we had about 10 years of declining life expectancy. I mean,
yes. Despite spending 5% more of GDP on healthcare than any other OECD country, developed country.
Even after the fall of the Soviet Union, you didn't see that. Especially across certain categories, white men especially. You are seeing excess death that are not normalizing even with COVID. And it's quite significant. In Europe, I don't have the data for the US, but in Europe, we're talking about 500,000 excess deaths for this year. You are seeing a rise in long-term illness. So maybe that's long COVID, maybe that's something else. And then you see also in the younger generation, the Gen Z, like a lot more anxiety, social difficulties. So I think both things contribute to the tightness of the labor market. You have people have the opportunity to take on gigs, so they're a lot less likely to just accept the crappy minimum wage job at McDonald's. And then you also have almost a structural part of the labor market that is physically broken. And I think it's been going on for a long time because of policies for the past 40 years. We have not invested in humans in certain place. Screw the Midwest, screw the Rust Belt, learn to code, right, was the idea. And we created this monster with opioids, with lack of investment in healthcare and education. And it was somewhat hidden because of immigration, right? I mean, we were lucky that we had between the tequila crisis of 1995 and 2007, you had 12 million Mexicans across the border. And these were young men, for the most part, healthy, ready to work, very easily integrating the US economy. And that kind of hid the distress of the US working class. But now these flows are reversed. And I thought that was interesting. Yesterday, Paul mentioned that during the press conference, there was a question of immigration. And he said, yeah, I mean, everybody I talk to is, again, immigration is a problem because, yeah, now we are seeing the reality. An historical analog for me is what happened to England during the Industrial Revolution, during the Boer Wars. So this was when the British were fighting the Boers in South Africa, right, turn of the 20th century. So they start recruiting in the Cockney part of London, like the workers, and they realize with horror that the average 20-year-old Brit, looked like a 60-year-old, and they had all sorts of lung condition because of coal and growth deformities, and this is the moment where like public hygiene started to become a movement because the British aristocrats who were living in the castles and very much like the Fed, if you will, today, they didn't know the proletariats were in.
They were at Downton Abbey.
Yes, exactly. And I think we're hitting the same moment in the US where we realize with horror that our lack in investment in people, especially working class people for 40 years, is an economic problem.
Absolutely. But there is hope to that, the gig economy, and you do fall out closer than anybody that I'm aware of. And I do think it is unfairly or improperly off the radar of most of them. So it's an intriguing theory. I do see people like David Rosenberg say this idea of people working 2 jobs is a sign of desperation, not a sign of strength or a sign of upward mobility. And, I'm not sure. We got to think about that more, but.
Would David Rosenberg ever take joy in anything?
Well, he's the bond market. Yes. When the bond market rallies, he takes tremendous joy. But I did want to get to this idea of, could both of these schools of thought, you're kind of in the minority right now in terms of saying, you're not the only one, but I'd say that you're quite overwhelmed, which actually, it's the old Mark Twain saying, when you find yourself on the side of the majority, it's time to reform and, or at least to rethink your position. And it does worry me, the majority of economists, because again, I do believe we are going to have a recession if we're not already entering one. But I'm constantly challenging that view. And I do worry that the majority of economists who never called a recession before are, by some studies, not all, predicting one this time. So that, but could it be, because what we're dealing with, something we haven't seen in 50 years or so, or 45 years anyway, a very high nominal GDP, but very low real GDP. So because I think you would probably be of the mindset that, hey, what really drives the economy is nominal GDP. I mean, that's what people get paid in, that's what people spend. And also it's really, frankly, what the government needs to have happen. And I know we're going to talk about this in a bit, is this idea that, get nominal GDP to run at a much higher growth rate than, say, the interest on the federal debt. And you go into this deleveraging process, it's kind of a stealth default. So could it be that, next year we'll see, a -1% print on real GDP, just to pick a number, but we might still see, 4 or 5% of nominal GDP growth?
Yeah, that's there's a lot in there. So I'm gonna try. Everything you say is correct. So just for data point here, if I'm looking at the Atlanta Fed nowcast, which is the their best forecast of GDP based on whatever available data for Q4, they're looking at 3%. Now we have 7% inflation. That means double-digit nominal GDP growth.
Right.
Something we haven't seen since the late 80s. And I would argue, I absolutely agree with you that it's nominal GDP that matters, not real. What's real? It's one arbitrary number deflated by another arbitrary number with so many statistical adjustments that you, especially also in a service economy. I mean, what's my productivity? I write research notes and I travel the world to speak at events. Like, how do you measure my productivity? How do you measure, like in a broker dealer? Like, okay, so if we charge more in terms of, if we increase our commission rate and our clients accept that, does that increase GDP or is that inflation? I don't know. What about Netflix? Like, if Netflix produces, a gazillion shows, is that more GDP or is it just a bunch of garbage? Like, my point is GDP was a great metric when it was created out of the Great Depression, World War II, when what you wanted to know was how many steel bars are we producing, how much concrete is going out, how many housing units, how many roads, like when we have this very tangible economy and when power was in these tangible assets. But in a very intangible service-oriented economy, real GDP is almost irrelevant. It's immeasurable, especially if I'm right about the rise of the economy. What is the impact on GDP of the rise of the influencer economy? Are Instagram models adding to GDP or are they subtracting from it? I don't know. I really don't know. So if you cannot measure real GDP, I think you have to stick with prices. Prices tell the truth. And when you see prices that are rising as fast as they are, and we can go into the CPI report from last week, but in general, we've had much higher inflation. To me, that is the indication that that something else is going on in the economy that's not being captured in the statistics. So as far as 2023 could be, you know what? Yeah, maybe. One day, the National Bureau of Economic Research will have their press release and they'll say, we think GDP contracted and blah, blah, blah. That will meet our criteria for sustainable, widespread. I forgot what it is, but, it's not just 2 quarters negative GDP. Well, they'll make that announcement and that would be it.
So it almost sounds like you're saying that pay more attention to nominal GDP than real GDP, because that includes prices and it's more all encompassing. There's fewer adjustments. So I'm sure it's not perfect, but it's probably it's less subject to
Yeah.
manipulation.
Yeah, you want to be, my view with anything quant is you want to be you want to be broadly correct instead of being precisely wrong. And I feel like, especially at a moment like now when national accounting is all messed up because of COVID, because of the shift from goods to services, because of the work from home, because of the rise of the services, because of the rise of the gig economy, a lot of our conventional national accounting aggregates are broken. And I would like instead to fall back on things that are easily observable, which to me are one, tax collection, and two, prices.
Well, let's talk about a third one where I think we do see eye to eye, and that's an earnings recession.
Yeah.
Because that's going to be hard to fudge. And I do believe that we're looking at a pretty serious earnings recession next year, and I think you concur with that. So, but please, I don't want to put words in your mouth once again. So tell me, well, I know what you really think, but our viewers would like to hear it.
Yeah. So right now we have earnings X energy shrinking a little bit, with energy kind of holding on around zero. And then you look at consensus estimate is that it's just gonna, as always, right? The second half rally always be better the second half. So we'll have this EPS will expand by 10% next year. Okay. Now the interesting thing is that at the same time, because we have such a strong recessionary consensus, analysts are penning in that revenue growth is going to slow from about 10% where it is today to about 4%. And this is an interesting divergence, right? I mean, like, oh wow, your earnings going to go from negative to plus 10, but your revenue is going to go from plus 10 to 4.
Which implies margin expansion, dramatic.
Yeah,
margin.
But by the way, margins always expand the same direction as revenue. Like this is the it's almost impossible to expand your margin when your top line is contracting. I don't think it's ever happened before, and I don't think it can happen in a world where you have to pay more for labor, more for energy, and more for capital. Like your three main inputs of the production process are all going up at the same time, and yet analysts are telling you that margins are going to expand. So no, I don't see it. So as far as recession, I say I don't know. Maybe there'll be a recession, maybe not. The recession that I can see is going to be an earnings recession.
Which I think for most people listening to this, that's what they really need to focus on, because that's what's going to have the most impact on the stock market, which most people listening to this care about. So that's to me, that's really kind of the ultimate indicator, and should be a worrisome factor for all these people who've gotten bullish again. It is amazing. We were in depths of despair in early October, and then get almost euphoric a couple months later because of price action. Kind of what you were saying earlier about how fund flows chase performance typically. So one other nuance to this whole thing, and you were kind of touching on this earlier, is what's happening with corporate tax receipts versus individual tax receipts. Because corporate tax, I would say government tax receipts. I mean, your beloved state of California, where you're based, I know it's not corporate, but I think it's something like the fourth or fifth largest economy in the world. And the fact that it's now gone from I think it was $100 billion surplus earlier in the year to like $25 billion deficit almost overnight. I mean, that's pretty sobering. So are we seeing some straws in the wind, or maybe 2x4s in the wind because of that kind of stuff?
Yeah, California, I would say, kind of long-term issue. I mean, it's so dysfunctional there. I don't know where to start, but one issue is the reliance of government revenue on the stock market, really, and then real estate transactions. So it accentuates the booms and the busts. So when the tech sector does well, money flows into Sacramento, and it doesn't stay there, right? I mean, just
not for long.
Not for long, no. So
as quick as you get it.
So, but we are seeing weakness. I mean, it's not normal here. Like go to downtown San Francisco. I mean, it's a ghost town. Like our office occupancy rate is like around 40%. A lot of restaurants have closed and not reopened. But it's weird because it's not a crisis yet, and I think it's the reason it's not a crisis yet is because there's so much money left from the prior cycle that we can still go on the what's left. Like for example, typically tech companies, they raise 2 years of expenses, right? So now their business is going down. The startups, the economics make no sense, but they can still hold on a little bit. So we are not seeing the kind of foreclosure and seeds of economic desolation that I would be expecting. Maybe that will come.
Well, to your point, one thing that Danielle DiMartino Booth has said, who's much more guarded on the economic outlook than you are, is that a lot of these tech layoffs come with severance packages, and the severance packages are still running, so you really haven't seen the true impact yet. But you brought up something earlier that I wanted to touch on, because I'm confused by this. I see such divergent numbers in terms of this excess savings, or said a little bit differently, excess cash that's built up since COVID hit. And kind of the standard line is it got up to about 1.7 trillion of excess savings, and it's been drawn down to somewhat below 1 trillion now. But you just wrote up, and I've seen this elsewhere, that if you look at this, like basically savings and checking household, readily accessible cash is 4.7 trillion now versus a trillion pre-pandemic. So it's up by 3.7 trillion. That's a big number. And presumably that's money that could easily be spent, but that it really diverges with kind of that official number. So how do you reconcile those two?
Again, I'm not sure how the savings rate is calculated. Is that a BEN number, BLS? My impression is it's a plug between two surveys. There's a survey on income and there's a survey on spending, and then that's the plug between the two. And I suspect, and I think it was Bismarck said that about politics. Is politics are like sausages. You really don't want to know what goes into them. Same thing with statistics. You want to see the final product. So
this really said there's lies, damn lies, and statistics. And
correct.
Somebody who studies statistics all the time, I got to say there's a lot of truth to that.
So I would go with, if people have cash in the checking account, they'll spend it. I mean, this is the American way, right? I mean, this is
absolutely. We're not Japan that way.
And by the way, one thing. So this is data from, I believe, you can find on the Atlanta Fed website the cash balance and break it down by income quintile, and it's across all quintiles, which is quite, and it kind of speaks to my point that it's the working man of America is getting a pay raise. Like initially, COVID was really just, it went to the top, right? You had all these people abusing the PPP loans and the tech moguls making a lot of money. Stock market went up. So the first wave of COVID was went to the top. But maybe because of the gig economy, maybe because of the hot labor market, maybe because trickle down, even low-income households have more cash in the bank account today, a lot more than they had pre-COVID, which again supports the view that people hurt, like try buying eggs, right? It's crazy expensive, or gas has dropped, but hotels, air tickets, whatever. So people are going to be angry, but I don't think they're going to cut down the family trip to Florida this Christmas, or the not buying toys. They'll just, what we've seen so far is you have these high prices, companies are raising prices, but consumers are able to take it.
Well, if you're right about that number, that's a big positive going into 2023, and I think would be supportive of your no recession argument.
And another point I want to make on 2023. Something else will happen in January 2023 is going to be the quota, Social Security cost of living adjustment. It's going to be the largest cost of living adjustment, I think, since the 70s, 8.5% increase, and that's going to go to, I think it's like more than 40 million people that are either retired or disabled in the US.
Yeah, I think even more than that. I think closer to 60, but
yeah. So that's
it's the second big one in a row. Last year's was a big one. It wasn't as big as this, but it was like 6 or 7, right? So that's back to back. That's a huge increase in the entitlement spending.
Yeah, and that's how I see kind of inflationary spiral being able to develop. Is on the labor market. I think the labor market is still tight, will remain tight, because you have the rise of the gig economy that allows people to name their terms, basically say, hey, I don't want my job, my crappy minimum wage job, I can drive an Uber. So I think wages will continue to keep up with inflation, which is what we've seen so far. And then you have this much larger and rapidly growing share of the economy, which is retirement or the disability economy, which is really where all of the growth has been, which is already indexed on inflation. So we are, the US today looks a lot like some emerging markets like Chile, where everything is indexed on inflation. So that once you have inflation, it becomes more persistent than in a country where you don't have that link between inflation and people's incomes.
Well, exactly. That gets to my point that I was making earlier. I mean, if you think about these Social Security increases, I mean, it's going to create a lot of nominal GDP activity with all that money hitting the system, but really net of inflation, it's nothing. So very pro nominal GDP growth, not very pro real growth. And we see that with wages too, where wage increases have been fairly strong, but for the most part running a little bit below inflation. But what I did want to go over is a couple of my big worries I don't see get a lot of attention. And I'm curious of your take. One is, and this relates to the whole bubble 3.0 thesis, that this time, I mean, obviously, well, I shouldn't say obviously, but this, that bubble 1.0 was tech in the late 90s, early 2000, and then bubble 2.0 was the housing bubble you were touching on earlier. This is when all the Wall Street firms were recruiting people, right out of school and, over hiring and so forth. And of course and it was the mortgage excesses that were really the disaster of that. And then bubble 3.0 was the one that we had here more recently that I think he called it the everything bubble. I've called it the biggest bubble ever. It was, I think, a crescendo. And one of the things that also got lifted by that was housing. And, we have, I don't think any question about it, a housing bubble in the United States, but with a better banking system, more able to withstand shocks, hopefully. Though we worry about that shadow banking system that I mentioned earlier. But overseas, the housing bubble was even more extreme. And it's bursting. I mean, countries like Canada, New Zealand, Australia, England, the Nordic countries where some of those homeowners were able to get paid to take out a mortgage. One of the true absurdities of negative yields, negative interest rates. So you've got that issue. And then I know this is a kind of a complicated thing, but the other thing is what's happening with the federal government. And what, you were talking about the Social Security increases. I think the interest cost to the federal government next year is going to be something like 1.3 to 1.5 trillion. So we could be, if the economy goes into recession, we could be looking at $2 trillion deficits. And you've got the Fed doing QT. You've got Social Security now having to sell government bonds out of their so-called trust fund. You've got the Bank of Japan divesting treasuries. You've got the Bank of China divesting treasuries. So I guess those are, to frame it, my two big worries for next year: a bursting of the global housing bubble, and then this potential U.S. government funding crisis. Do either one of those really worry you very much?
Yes and no. Yes, in the sense that it's the way you put it is just daunting, right? Because basically you had like three structural buyers of treasuries: Social Security Administration, foreign central banks, the Fed. And this was where all the new treasuries were being issued for 20 years now. And they are all turning net sellers at the same time, right? I mean,
Exactly.
So, I mean, that is huge. So yeah, I'm the quick answer is I'm bearish on the long bond. I think I don't understand why we yields drop so much from 3.5 to me for the 10 years is ridiculously low. It's probably one of the biggest mispriced asset, and then the biggest risk going in 2023 is going to be curve steepening, but not the steepening the market is expecting. The market is expecting the dovish steepening, right? Because the front end is going to collapse.
Right.
The end is going to
Good point.
Right. I think I agree that it will be steepening, but what about the other kind of steepening?
Bear steepener.
Yeah, where the
and that's actually what Louis Gott believes too. He thinks the 10 years headed to, he just said this to me the other day, he thinks it's headed to 4.5 to 5%, which would be a heck of a shock to the market. Of course, we were close to
I could very well see that. I mean, that's kind of consistent with my view that you have, structural inflation of about 5%, and that, it's not the worst thing, and the Fed should just learn to live with it, and we should just adjust relative prices for that, and that includes the price of US Treasuries. So I'm bearish on the long bond. I don't think we'll have a funding crisis in the US because at the end of the day, you can always monetize it, right? I mean, to me, that I kind of have an MMT view of the world where the Fed and the Treasury are really two sides of the same coin, and they work together. And you see that already, by the way, right now. the Fed is taking massive operational losses, right? Because on their asset side, they have all these bonds they're monitoring QE at 1 to 2%. And then on the liability, they mostly excess reserves on which they have to pay close to 5% now. So they are having huge operational losses. What do? They just print the difference. I mean, they created an entry in the balance sheet. So, I'm not kind of like a Tea Party person. Like, I don't think the U.S. government is going to go bust or the.
Oh, no, they can't. But what you just said was that to avoid that happening, the Fed will have to go back into QE mode one way or the other. And I think they'll try to cover it up as much as possible. Like what they're doing right now by running down the Treasury General account is kind of a stealth form of QE, which is kind of neutralizing or sterilizing the QT, quantitative tightening, that they're doing. So they'll play those kind of games. But I mean, numbers are so big. I think they're going to run out of runway to be able to obscure what they're actually doing. And then if the bond market goes into, if you're right, and we get another bond market riot, man, they're really in a tough position.
Yeah, and that brings me to what I think is the more likely policy pivot from the Fed is going to be on the balance sheet side, more on the rate side. And I wish people would ask, like, look at the press conference. Basically, every question was like, are you going to do 25 or then 50? What? Like, okay, why? Whatever. Why do we get? It's all about the rates. And then same thing for the pivot, right? Starting in May, the price to get like almost 3 times now. I think it's a lot easier for the Fed. Makes a lot more sense for the Fed to keep the Fed funds rate at 5 or 4.75 or wherever they end up, and then adjust the balance sheet because it's a much more flexible tool. And if you and I are right, they won't have a choice anyway, right? So I think that the true pivot of 2023 will be the resumption of QE and maybe with a higher level of interest rates. I mean, there is no reason why, the two tools must work together, right? I mean, they can have restrictive rates and easing in terms of liquidity. That would not be a bad policy combo, in my opinion.
Well, it's going to be interesting. I certainly think that's one of the biggest challenges that the U.S. government faces next year, and the spillover effect could be fairly significant. But you don't seem as concerned about the global housing bubble popping and some of the extended prices in countries like Canada. We think we've got nutty prices, but far worse north of the border, and those prices are coming down hard.
Yeah, I follow it less, but I agree with that. I mean, it's always crazy, right? I mean, Vancouver was ridiculous. You had all this Chinese money flowing in, which is drying up. I mean, 20 years of bad policies, undersupply, and over. I mean, yeah, it's hard to see this end well. I mean, one thing. The question is a contagion, right? Whether it moves to the banking sector. Well, one thing I'll say about the Canadian banks is that they're really good at squeezing customers out. You go to Canada, you pay for everything. It's ridiculous, like you pay for checking account. It's a cartelized market. So maybe they'll just they'll take the loss on the real estate and just make customers pay for it. I don't know if that could work in Australia. I mean, yeah, it's global, and which is why, by the way, in my view, this had to end. Like you were mentioning earlier, the Danish people who were getting paid to borrow. I mean, this was insanity. That the world was upside down. So we couldn't do like it. I hope you never have to write bubble 4.0. Like that's what we've been doing, right? Because we never wanted to really address the issue. We just did the same thing. Okay, cut rates, put more liquidity, and then reinflate a bubble on top of another bubble. And we reached this almost like absurd paroxysm with the meme stocks and the crypto and like.
Absolutely.
Are we going to keep doing this stuff forever? No, I thought, so in the US, it was the crypto and the meme stock insanity. In Europe, it was negative rates and then the insane housing prices. This model was not going anywhere. This was a dead end. And in a way, I view inflation as the deus ex machina that will force the system out. And of course, it will be painful because we'll have to reprice all this insanity. But there is no other option. And it will eventually lay the ground for something that we haven't had for a long time, which is real, genuine economic growth this is not a sequence of bubble on top of another bubble.
Right. No question that central banks, Western central banks, encourage and enabled bubbles and using bubblenomics to try to get out of tight jams, and it just makes the situation far worse in the long run. And that's one reason why I don't think we're going to just skate through this the next couple of years, because this was such an enormous bubble. I just think the bigger the boom, the bigger the bust. And it was one heck of a boom, a pseudo boom, I think you could say, based upon fake money, but it's, the chickens are coming home to roost. But I know we're coming up on an hour here, and your time is very valuable. And I could talk to you for hours on end, but I do want to be respectful of your time and talk about one of your really important points that you brought up here lately. So if almost everybody's familiar with the term BRIC, which was Brazil, Russia, India, China, became very famous over the last 20, 25 years, something like that. You've coined a new acronym, BIMCHIP. And as I understand it, there's a couple of holdovers from the BRICS in your BIMCHIP, but it's basically a way of articulating your bullishness on certain emerging markets, correct?
Yeah. So BIMCHIP is Brazil, Indonesia, Mexico, Chile, India, and Peru. These are all emerging markets who are up in dollar terms for the year. And if you look at that list, this is not the list you would have expected to outperform in a year when the Fed tightened by 400 basis points and the dollar index rose to, I forget what the peak was, but, we had 140 on the yen and the below parity on the euro. And, it flies a bit under the radar because the MSCI emerging markets is so heavily skewed towards China and Taiwan and South Korea. It's essentially, the MSCI EM is a tech index. So, it's a tech East Asia index. So this is kind of more what I grew up thinking of what emerging markets were, countries with a fairly young population, big mining industry. The index is BBC, right? Beer, bank and cement, a lot of extractive industries. And these are, I think, countries, for each of them, for the different reasons, are benefiting from global inflation. In the case of Brazil, you can see it. The biggest, food exporter, well, depending on what, but, close to the US, big oil sector. Chile has, 30 to 40% of the world copper reserve, lithium. Peru is gold, copper, silver. India has benefits from friendshoring or generally slower growth in China. Indonesia has one of these really amazing quiet success stories with democratization. Coal, it's insanity, right? Coal is now the new energy is coal in 2022, as we are no longer able to buy gas from Russia. We have to buy coal from Indonesia. These are places also where you have fairly little inflation, or at least, well, you always have high inflation. So for them, it's like, okay, yeah, 7% inflation. That's just that's Tuesday for them. And the policy rates are much higher, right? I think that's a very peculiarity about this hiking cycle. Is usually the Fed starts and then everybody just like scrambles to follow. But in this case, the emerging markets
went first. They tightened first.
Brazil was at, I think the Selic was at 12% before Lagarde even raised from minus 50 basis points.
Well, even Mexico today's got 10% short-term rates versus 8.5% inflation. So they have positive real short-term interest rates, which, we're not even close to yet in this country. I'm not sure we'll ever get to positive real short-term interest rates, maybe other than for just a very short time.
Correct. So you have, looking at 2023, that because they were early on the rate hikes, and yeah, I do agree that at least that wave of inflation is cresting. I think there'll be another one, but for now, I agree inflation is going to fall. So now you can look at rate cuts.
It's going to fall, but not to 2 or 3%. It's going to plateau, bottom out at a higher rate than we're used to for many years.
That's my expectation as well. But in the short term, for these central banks, you'll see falling inflation. They have very high positive rates. I also suspect, the dollar, the dollar eventually at some point is going to weaken. It already started to do that. So you could have this good combo of easing monetary policy. The Chinese reopening, of course, is going to be for almost all of these countries, the biggest trade partner is China. So Chinese demand coming back should be a good boost. So I would bet on these. If you want to maintain the equity position in 2023, I would look at emerging markets like China.
It also seems to me a very bullish setup for energy. And frankly, our viewers would be shocked if I don't get on energy, given my positive inclination toward it. And you've written actually that you think that the Fed put is a goner, but that the OPEC put is very much in play. So maybe explain that. And you mentioned China reopening and strong emerging markets and even strong nominal GDP growth in the United States. That all seems to be pretty bullish oil, despite a lot of bearishness on it currently. So just maybe a quick overview of your thoughts on energy.
Yeah. Sorry. No, I'm bullish for the reason you mentioned, and I would have an argument which is almost a portfolio construction argument. Even if you're not fundamentally bullish on energy, I think that was a lesson of 2023, is you wanted energy in your portfolio to diversify your inflation risk. On most days when the market was down, energy was up.
Right. Good point.
That long-term treasury didn't work, the yen didn't work. Unfortunately for me, gold didn't work. The Swiss franc didn't work. So in a world of structural inflation, it could be that commodities and energy become your risk-off asset. So you want to have it because almost a Markowitz argument, right? Even if the return is low, which I don't think it will be. I think we've underinvested in it for decades. But even if because it's uncorrelated with the rest, it helps stabilize the return on a 60-point portfolio.
Yeah, and I don't think I've ever seen a time in my career, which goes back to Jimmy Carter when he was in the White House, putting solar panels on the White House the first time, that we've seen such unbelievably low inventories, especially adjusting for the Strategic Petroleum Reserve releases and a bear market in oil prices, at least from the winter peaks. So it seems to me a great setup for oil, at least oil prices. It's funny though that another divergence has been the fact that you've had such strong performance with the energy stocks themselves this year, at a year when oil, as of the other day, was actually down on the year. I've never seen that one either. But anyway, don't want to get you going too far down that one. Last point, and then I'll let you go, is this BIS, Bank of International Settlements study that came out here recently that talked about all this dollar-denominated debt, foreign currency swaps, and how this is going to be a big blow up. And I've run that by Louis Gobb. He doesn't think it's a particularly big deal. I haven't seen you write on it, but it's fairly new. Is it something that worries you, or do you think it's much ado about not very much?
So I read the report. I actually like the BIS, among all international organizations. I think they're the ones that are the least afraid to fight for the consensus. Claudio Borio, the author of the report, is, I'm surprised he's in a job. I mean, he's capable of heterodox thinking, which usually doesn't go down well at places like the IMF or the World Bank. So I pay attention to what they publish. I'm not deep enough into the plumbing of international funding market to really assess. My impression is that this always been going on. The dollar is the world reserve currency, so there's constantly a need for dollar funding, and people are funding non-dollar assets with dollars, so they can get squeezed if they don't match the maturity. This can create issues. I would, the focus on the notional amounts, I think that was really the crux of the argument was you have all these swaps, like 35 trillion. In a swap, you don't care about the notional, it's the payments, right? So I think there was a bit of scaremongering here.
As long as the counterparties don't start blowing up. And I think actually you did address that. I was wrong to say what I did earlier that you hadn't written on it. That was one of your points, is that and Jamie Dimon's talked about this too. It's net amount of exposure you look at. But if you do get a Lehman type of situation, right, and that fear starts to go viral, then then all of a sudden it is the gross exposure that becomes the critical factor.
Right. So
Well, it doesn't sound like you're that concerned.
I put in the black swans category. I think anything is possible. Maybe I mean, people think about Credit Suisse a lot, right? As you look at the CDS on Credit Suisse, and uh, it's always possible. Maybe it comes out of China. Maybe it's some, there's a lot of leverage in the system. We've had 20 years of bubbles on top of bubbles and very cheap money. So that creates incentives, and that makes the system less stable. Now I don't know if that's more risk in 2023 than it was in 2022 or 2015.
Well, I mean, what we do know is interest rates are up drastically, and with all that leverage, that's got to make it a more dangerous situation. Kind of getting back to my concern about the U.S. being able to fund its enormous deficits and roll over. I think something like 30% of the government debt rolls over in the next 2 years. If it's not that, it's pretty close. Well, just want to say thanks to the Max, Vincent. You have been just as articulate and persuasive as I thought you'd be, and so thanks again for sharing your valuable time with us. I wish you a good day. And it seems like you don't have COVID, right? You might have just a cold.
No, I have the flu. It's been going on for like a couple of weeks now. My kids are sick. I mean, it's a bad one. Everybody's getting it in my kids' school, and
But it's actual flu, not COVID, because it seemed like for so long the flu went away and it was only COVID. But you got the old-fashioned kind, huh?
The old-fashioned, which, as far as I'm concerned, is way worse than COVID. But
it's true in many ways for younger people. Well, feel better. Merry Christmas to you and your family.
Thank you.
See you in person soon.
I would love to, Dave. Thank you so much.